Welcome, everybody. That's because I haven't started talking yet, Nika. But now you should. Welcome, everybody. This is Fibonacci Fridays. I'm your host, Andrei Knight. How's everybody doing today? How was your week? Did you guys make some pips out there? Excellent, Daniel. Cool. All right. Well, Kevin, John, let's see what we can do to make it better. Euro USD is one where my group made some pips this week. I'm going to show you how. Fibonacci is all about measuring the existing trend and trying to figure out how much further it might go. Oh, good, Donald. Very glad to hear it. They're pretty useful things, aren't they? Where is this thing likely to find bottom? How much further does it have to go? Is it worth still getting in or not? Where is it likely to go next? These are all questions we can answer with Fibs. How many lots should I use? That's not a question Fibs will answer. Where should I put my stop? Fibs can be part of that decision. They help identify support resistance. They're not the complete answer to that question. Where exactly do I get in? Once again, they identify support resistance. Sometimes they can be part of the trigger. Not always. I often combine Fibs with other tools such as moving averages, prior highs, prior lows, to help me with that one. In other words, you guys, Fibs are not a complete system. I'll give you that disclaimer right away. They are a tool for a specific purpose. Identifying how much longer a trend has left in it. Okay, that's what they excel at. They're not a cure-all for everything in every situation. That said, they are darn useful, and I think a worthwhile tool to add to your toolbox. And because of their strengths and also because of their limitations, they play really well with other systems. Meaning you don't have to stop doing what you're doing already. Use your favorite method to size your positions or set your stops or find your entries. But add Fibs to your arsenal, to your repertoire. Okay, you can lay them really neatly over and on top of what you're doing already. That's the cool thing about them. They don't have to replace anything that's already generating pips for you. And you're right, Boyke, it does kind of depend on Draghi, doesn't it? In fact, his comments today are what led to our bonus round. Let me explain the first part of the week to you guys. And then I'll explain the bonus round and how that came about today. I'll also give you some possibilities of what to look for next week. And how to tell between them. How to tell which of the two potential scenarios is happening and where that's likely to take us. All right, in order to use Fibs, you guys, you basically have to be able to count to 4. All right, some people get nervous when you mention Fibonacci. They think math. Math automatically equals complicated in many people's minds. I'm here to dispel that myth. If you can count to 4, I'll have you comfortable on Fibs by the end of this hour. And your brain won't even hurt, I promise. So first, I mentioned you have to measure part of the existing trend in order to have predictive value for the rest of it. What stands out to you as we look at this daily chart for the euro? And by the way, this is by no means a daily only tool. This is by no means a euro USD only tool. You can use it on any currency pair. You can use it on most any instrument. I use it for trading oil and gold quite often. Nor are you restricted to the daily chart. I'm showing you the daily chart so you can see the whole trend. But Fibs are really time frame independent, as you'll see when we get into it. Okay, so it doesn't matter the currency, doesn't matter the time frame. I'm picking an example because, hey, this is what we were trading all week. This yielded another good trade today. It's fresh in my memory. I like to base my lessons on real-life examples. Okay, you see a downtrend? Great, Sandy. We're wondering where it might come to an end, how much further it has to go. Donald, DZ, you both identified this big red candle. Yeah, that's what catches my eye first, too. Good. Let's work with what catches our eye. Now, if you notice, though, the top of this red candle isn't really the top of that particular slide, is it? There's a higher point on this green wick. We start with the red candle because that's what draws our eyes first. I call it the back of the room test. When you first walk into your trading room and you look at your charts from the back of it, whatever catches your eye is a good place to start for the day. So yeah, this is what caught my eye first. And then what I do is I kind of work my way out from this. Okay? This was the highest point? Great. But it's not. This green wick is a little higher. So we're going to call that point A. Essentially, where that big slide down began, that's bigger and different from the rest of the things we're looking at. Okay, now let's look at the other end of the candle. This wasn't really the bottom, right? We had a brief pause here, then we dropped lower. Then we dropped lower still before the prolonged pause or retracement back to the upside. So let's call the bottom of this green wick here point B. Or how far down that slide took us before we had the first major retracement or pause. Okay? So wick to wick, because in this case we're measuring distance. Okay, trend lines I like going by the bodies. For example, if I connect this body to say this body, I pretty accurately predict the bottoms of this body and this body, as well as, here's for example a good trigger for an entry, when we cross that line. And if I zoom in on a lower time frame, for example, like say the hourly chart, check this out. Okay, we've been down below this line several times, but notice what happened. We failed to find resistance. We're down below again. We failed to find resistance. We're down below a third time. We failed to find resistance. We're down below a fourth time. We failed to find resistance. But look at this. We're down below it. We come up. We close below it. Bodies for trend lines. Okay, not so much concerned with the wicks. We close below it and we open below it. This, for example, is a great entry trigger. And I'm not the only one who thinks so, because look how much longer the candles suddenly get. That's because people started shorting it here on this particular hour. Okay, so you see what I said at the beginning. Fibs can be part of your entry decision, but they're not the whole story. In this case, all I have to do is draw a simple line on my daily chart that gave me a really, really nice clear trigger on my hourly chart. Something was different this time that did not happen each of the other times we were below this. And that is that we not only broke below it, but we retested from the other side, and it held through the close. The big red candle not making a higher high. Great question, Sandy. Let's go back to our daily for a moment. That's a good indicator, actually. The fact that it failed to make a higher high suggests it might go down and make a lower low. Right? When something fails to make a lower low, that's a good indication that the next candle will probably take you higher. Okay, so here we had a little bit of a retracement up. This failed to make a higher high. It suggests we're done moving up and we might start moving in a different direction. So once you've identified 2 points, remember what I did. I started with what caught my eye, and I worked my way outwards to each edge. But unlike trend lines where we go by the bodies, as you've just seen, with Fibonacci, we're measuring distance. So in this case, I'm going wick to wick. Okay, furthest point to furthest point. That makes sense. If for a particular tool you're ever wondering, should I use the bodies or the wicks, simply ask yourself the question, am I seeking market consensus or am I measuring distance? If it's consensus you're after, go by the bodies. For example, a break or a retest of a support resistance level. We don't care so much about the wicks, levels that were poked and rejected. We care where the bodies close and the new candle opens, right? That's a true test of whether something bounced or not. If you're measuring distance, like we are with Fibs, the question we're trying to answer is how much further is this thing going to go? So when you're measuring distance, go wick to wick. Measure the whole distance, in other words. Not so tough. Just ask yourself what it is you're attempting to measure. The answer will usually be pretty clear to you. So now that I've worked my way out to the edges and found them, I'm going to reach for the Fibonacci tool. And very simply, I'm going to go to the top of the wick by point A. I'm going to hold my mouse button down, not letting go of it, and I'm going to drag to the very bottom of the wick by point B. And that's where I'm going to let go of my mouse. And right about now, you should be looking at this high, for example. You should be looking at this body here, where this candle ended, this candle started. You should be looking at today's bottom, the lowest point we reached before we started retracing up. And hopefully you're thinking, okay, Mr. Knight, you've got my attention. I'm glad I hung around for this webinar at the end of my Friday instead of running off to my weekend. Good. Because it's about to get a heck of a lot more interesting from here on in. We're just getting started. But hopefully you're seeing that some of these market moves, not only the bottoms, but the retracements along the way, are maybe not so random after all. Maybe there's a rhyme or reason to it. We're also, by the way, we're halfway done at this point. I said 4 points, right? We got 2 of them on the screen already. Nobody's brain hurts. Told you it'd be simple. John Savage, I'm not sure I understand the question. Am I doing what on day B? Drawing the fib? Technically, it would be a day after day B, because the nature of a reversal, both. The answer is yes. I did it the day after day B. I did it again today. A fib is not good for one day only. It's good for the entire trend, which usually spans multiple days. If you're drawing fibs on a daily chart. If you're drawing a fib on a 5-minute chart, I can't guarantee it's going to be a multi-day trend. But it'd be useful for measuring news reactions, for example, and figuring out what to do the next hour after news. It's all relative to the time frame you do it on. Remember, I said time frame independent. And you'll understand more of what that means as we get into this and look at it from multiple time frames. Okay, but I'll show you exactly how it generated an extra trade today, even though we thought the trend was finished after yesterday. I'll show you what changed our minds today, using the same fib. The fib doesn't have to change after you took a trade. I'm going to use the same fib on Monday. Either way, if we're done and start retracing back to the upside, or if we drop lower and keep going, either way I'll use the same fib. So it's not one fib, one trade by any means. Because, well, fibs have more than one level. Donald, great question. I placed my B here because this was the lowest point reached before we had a multi-day retracement to the upside. We made lower lows, sure, but that was after the retracement. That'll make more sense once I throw down my C. Remember, you're only looking at half the puzzle right now. Okay, so John, back to your question. I was able to plot the fib the day after day B, because the nature of a reversal is such that it has to happen in order for you to see it. My entry, as you saw by the trend line, ended up taking place 1, 2, 3, 4, 5 on the 6th day after I drew the fib. And that led to a multi-day trade that we got out of yesterday. Today we got into an extra trade that I call the bonus round. You'll understand why in a moment. And it might lead to another bonus round on Monday. Yet another one. Or it may not, and I'll show you what to do in that case as well. And yeah, Boyke, originally, of course. But in this case, remember, I didn't identify this candle. You guys all said it stood out. I'm just helping you understand what to do with it. Okay, in this case, Boyke, we're not measuring the entire trend, though you could. You know, we can zoom out to the weekly chart. Let's go to the very, very beginning of the trend. Okay, you can see you can have a much longer term fib, measure the entire trend. As a matter of fact, this current retracement up from our lows, I'm willing to bet 2708 is a great spot for us to find resistance. And this being a weekly fib, it would be a great place to end the week. So absolutely, the bigger picture is, yeah, you measure the whole trend. But for today specifically, you know, we have this unusual slide down. Unusual in that it's much bigger than everything that preceded it. So we're trying to make sense of this reaction, this particular move, which is part of this bigger trend, and how much further this might go. Okay, so we're taking a chunk out of the overall bigger weekly trend on a day-to-day basis. You heard me mention bodies and candle closes and candle opens. So I think you're starting to get the hint that I pay particular attention to when a new candle opens. Okay, so my analysis every day when I sit down at my computer starts with my daily chart. Why? Because we got a new candle there. That doesn't mean I stay on the daily chart all day. Every 4 hours, I'll look at the 4-hour chart to ascertain the current direction. Because as you know, a down day can still have up retracements, right? And vice versa. So I'll usually, once I have a daily scenario, where are we coming from? Where are we going to? And I'll show you how to identify those. I call those the windows of opportunity. Where we're coming from, where we're going to, kind of forms a little box on my chart. That's the window of opportunity. Then I'll zoom in on smaller time frames and trade within that window. If I'm expecting today to come from here to here, well, great. I know my resistance. I know my support. I know my potential target. I know I want to make that move sometime today. I just don't know when. The when part is when my 4-hour chart turns to support the direction. If my 4-hour chart is bullish, you know, that supports making this wick. But it's going to be hard to move from here to here, which involves moving down, if my 4-hour chart is aiming up. But once it also turns down, then I go to my 1-hour chart and I look for short entries or triggers, one of which could be breaking this 138 and retesting it as resistance, for example. But I'll show you all that as we zoom in. Okay? And that way, I'm drilling down until the only option I'm left with is the best one. If I get a long entry below the 138, I ignore it. It doesn't fit the scenario. If I get a short entry, but my 4-hour chart is bullish, I'm going to ignore it. Because it might go down, yeah. But it's probably not going to go down very far. The moves I want to get in on are the ones that are likely to go pretty far. Right? Remember this example? When we retested that trend line? I wouldn't want to, this, for example, I wouldn't want to be short on this candle and then get impaled on the retracement back up. I want to be short on this candle, on into this candle. This is the difference, for example, between having higher time frame support or being in the same direction versus not. Both went down. It's a question of how far and did they stay down. Okay, so if you've been getting into a lot of trades that you have to exit at break even or -1, or maybe they go for a couple pips and then they retrace and you get scared and you close it, only to see it go on to your target without you. If that's been happening a lot, the problem is not in your analysis. The problem is in your timing. The timing is right when you get an entry on your preferred trading time frame that agrees with the direction of a higher time frame and is within the parameters of a scenario from your daily chart. Then the timing is right as well as the direction and the analysis. See what I mean? Well, gee, all of that has to line up? That sounds like it doesn't happen very often. And you are absolutely correct. The goal is not to be trading all the time. The goal is to be trading when you know what's happening, and it's got a very high probability of success. Might surprise you to learn, I take maybe 2 or 3 trades a day. 3 is starting to feel like a busy day for me. In some cases, maybe 4 or 5, but that's it. A typical day for me is 2 to 3 trades. But they are 2 to 3 good trades that go a long distance and tend to be correct much more often than they're not. On the flip side, when I'm wrong, they tend not to go very far against me. Okay, so it works both ways to your advantage. You don't get paid by the hour. You don't get paid by how many trades you take. Okay, this isn't where is Waldo. Well, I found more moves than you did. Great, but did you make money on them? I get paid when a successfully executed plan comes together. So yeah, you trade much less, but the idea is you win more. You win more often, and you get greater distances on the trades you're right on. So it's kind of a double whammy. If time permits, DZ, I'll look at it at the end, okay? How many pairs? I mean, I do my daily analysis, Van der Meulen, on maybe 15 to 20 different instruments, not just currency pairs, but also some commodities, some stock indices. I'll probably look at the daily charts of 15 to 20 different things in my morning. Out of that, I'll pick maybe 4 or 5 that look really, really promising based on their daily open to watch throughout the day, out of which maybe 2 to 3 will actually materialize in a trade. So just like we go top down in our analysis, it goes through a filtering process until what I'm left with are the best options. I'm not interested in catching every move out there. I'm interested in catching the good ones. Sanjay, that's exactly what we're going through. You know, that's why I started on my daily chart. Because I'm showing you guys what I do at the start of my day. And Sandy, it'll come as we go further in this fib, continue to analyze it, and start to zoom in on some of these lower time frames. Okay, so stay with me. So we identified this move that was abnormal compared to what had come before. We traced it to the left to find its beginning, which isn't always the same candle. We traced it all the way to the right to find its ending before a retracement. Okay, that's what caught our eye, but the actual move was not just one candle, it was 5 candles in total. Well, I'm in the Pacific time zone, Manny, so my day usually starts around 10 p.m. An hour or two before Europe opens for business. Alrighty. The next point we have to identify, you guys, is point C. Point C is very simply how far we retraced up or back towards A. Okay, now we're measuring this retracement here. Well, I would say that's the top of that green wick there. What do you guys think? That was the highest point reached before we resumed the move down. Okay, I'm still not trading. Remember, the first part of the trigger came from when this existing, you know, if I see a ledge, I'm going to mark it. Simple as that. Body to body now. Distance wick to wick. Ledges and trend lines body to body. The trigger comes not even at point C. The trigger for the first part of the trade today was separate. Okay, first I'm going to show you guys the theory, then I'm going to zoom in and show you today. Okay, how to break the overall move down into individual trades. But the first part of this trade, how I knew we were done retracing up and were ready to resume the A to B trend downwards, came when this trend line broke. Okay, and once again, or if you weren't here earlier, here's how it looked on an hourly perspective. We broke below but failed to find a ceiling. Broke below but failed to find a ceiling. We did that several times, in fact. The moment we broke below and found a ceiling, I knew it was time to go. And I'm actually going to mark this candle so we can find the same spot. Here it is from a 4-hour perspective. Which of these candles is not like the other? Okay. And I don't have any other indicators on my chart yet. But I bet if I was to throw one down, oh heck, let's do it. Look at that. So much for lagging indicators. Where did they turn bearish? Right, on the candle before, on this red engulfing candle. The open of this 4-hour candle, well, we opened below the prior lows. My stochastics turned bearish on the candle before. The direction is down. And then I go to my 1-hour chart and I look for entries in the direction of the 4-hour chart, which is down. Okay? That was actually the open of the 4-hour chart. Okay, well, I'm not going to short here. We're bullish. We're moving up. Why would I short just to lose money? Okay, that was the open of the 4-hour candle. The entry came 1 hour later when we turned back down to agree with the direction of the 4-hour chart. And that doesn't surprise me, Donald. Remember what I said? Fibs play really, really well with other systems. So you don't have to stop doing what you're doing already. Okay, so that was the trigger for the first part of the trade. Let me finish up with Fibs. Remember, I said 4 points, so we have 1 more to go. And then I'll show you specifically today. Okay, so we measure A to B. We sit back and we observe where C is. Once we bounce down off of C to resume the A to B move, that's our trade. We trade C to D. And D, very simply, is where we expect the trend to end based on this retracement. Okay, and there's some very common moves, not always Vandermeulen, and not automatically. That's a common fib level, but not all the time. This is actually one exception. And in this case, I've had some people say, well, you say 161. Wayne McDonald says 138. Who's correct? My answer is yes, both. And I'll show you how. Okay, on my website, I have all of the movement rules summarized for all of these levels. But the 3 that I want to deal with today, the ones you'll see the most commonly, are these 3 right here. When your C retraces to 38%, more often than not, your D, or how far the trend is likely to go, at least in the first swoop, is 138. When your C retraces to 50%, more often than not, your D goes to 161. And when your C retraces to 61, more often than not, your D will also go to 161. You guys can remember that. So who's right, me or Wayne McDonald? We both are, because trends don't always stop at their D. Sometimes you have what's called a bonus round. Like we did today, and I'll show you how it got triggered. So these are the 3 most common ones, you guys. Let me give you a link if you're interested in some of the others that happen less often. And by the way, there's also a PDF document attached to the very first post in this thread. This will show you how to modify your fibs to look exactly like mine. Because notice what's happening here. Point B, where I originally let go of my mouse, is labeled 0. And the numbers count up in both directions, don't they? So this way, as you go back towards point A, from where you let go of the mouse, this is the percentage of retracement. Okay, so 50%, if I follow that line over, halfway between A and B. 38, roughly a third of the way. 61, roughly two-thirds of the way. Okay, the percentage of retracement. And I think you begin to understand why all the numbers below 0 are greater than 100. Greater than 100%. In other words, this is the percentage of extension. How far past B we've gone. Okay, and if the fibs look a little different than you've seen them in the past, it's simply because I'm using a little math to plot both retracements and extensions with one mouse click. All it is a little bit of a time saver. And that link that I just posted in the chat window, like I said, there's a PDF document attached to the first thread that'll show you exactly how to make that modification, at least for MetaTrader. If you're using another trading platform, you'll have to figure out how to get into the Fibonacci properties of your particular platform on your own, but you'll still be able to make use of the formulas once you do. And then that same document summarizes all of the C to D movement rules. Something else I want to point out on this one. While C is perhaps closer to 50%, it did not reach 50%. Neither the wick nor the body touches 50%. Okay, so you don't count the level you are closest to. You count the last level touched or crossed, or the deepest level touched or crossed, which in this case would be what? $38. Very good, Manny. And based on our C to D movement rules, a retracement to 38 is likely to go how far? 138. Once again, Manny, well done. And there is our fourth point, our point D. We're not finished yet. Stay with me. I'm still talking about the week that brought us to this point. I'll get into today's trade in just a second. Okay, so Fibonacci in a nutshell. Measure A to B. Observe where C is. Your entry will likely be sometime after C, not on C, because you got to see it first before you can react to it. But don't panic. You got several days of trading ahead of you. You don't have to react in the first minute or two. Okay? That's where many traders go wrong. They jump before they're certain. I don't have to catch every last pip because I'm going for hundreds at a time. I'd rather go for certainty over speed or being the first one in. You guys remember X-Men 3? Some of you movie fans or sci-fi comic book fans? One of the greatest trading lessons I ever learned came from that movie. Comic book movies to learn about trading. Go figure. But there's this part where all the bad guys are lining up, getting ready to storm this hospital where this character is that they want to kidnap. And all the bad guys start running and charging and hollering. And Magneto, second in command, raises his fist and starts to run as well. Magneto grabs him. He says, "Pawns go first, my friend." And all the bad guys are running, running, running. Suddenly the good guys jump out to save the day and a big fight begins. And Magneto looks over at his friend. He says, "That's why the pawns go first." Same thing in trading. You want to be first or you want to be right? You want to be first or you want to be rich? Your call. I'm not so hot on being the first one. I'd rather give up a few pips in favor of being more certain and having a higher percentage of being right. Insurance is never free after all. Okay, so the first trade, what happened this week to lead us to this point today, was from when we crossed that trend line to our point D, which was 138, or in other words, 1.2744. I'm rounding up to 44 because coming down from the upside, that's the level I would hit first. If you have 5 digits, don't round off according to math. 5 and up, 4 and down, the way you learned it in math class. Round according to what you're going to hit first, depending on the direction you're coming from. So if I'm coming down in this case, I round it up to 4.3 because I hit that first. If I was coming up from the bottom, I would round that 5th digit down to 4.3 because I'm going to hit 4.3 before I hit 4.4 coming from the downside. See what I mean? Round according to what you're going to hit first, depending on the direction you're coming at it from. So the first target on the downtrend was 27.44. But wait, we went further. Okay, that was today. That was a separate trade. And let me show you how we got into that one. Notice, yeah, we did go further. Here again, wick. I don't like getting impaled on big, sharp spikes. It hurts. We did go further yesterday, but we did not reach 161, did we? It was a failed attempt. If you got greedy, you got stabbed. The safe trade, in other words, was down to 138 yesterday. What happened today? Let me show you. Today, something happened that failed to happen yesterday. Yesterday we went further, left a spike, we came back up, and what? Failed to find a ceiling. It also happened overnight. Bears made another attempt to push price further, but again, failed to find a ceiling. We're looking at this hour by hour now. Look what happened 5 hours ago. Uh-oh. And it doesn't even have to be a big, long candle. It doesn't have to be dramatic. Look at this teeny little guy. We broke below, right? The wick represents where we were. Then we came back up, opened here, and immediately after the open, we shot up, tapped this as a ceiling. It held, and we came down, and then depending on your entry rules, the moment we came down past the open could be a trigger. The moment we made a lower low compared to this could be a trigger. Whatever your system says. Connect the bodies. The moment we broke the trend line. There's lots of different ways to find an entry. And they all more or less point to the same spot. The key is that we tapped our former D, our target from yesterday, now from the other side as the ceiling. Something we failed to do here and here. Okay, that's the key. Not the specific of how you get in. That's up to your system. They all point to the same spot, as you can see. I just did it 3 different ways and got the same answer. Okay, so our trade for today, and if you want to look at it, I bet the 4-hour chart was bearish at this point. I'm going to mark it so we can find the same spot. Let me go ahead and throw an indicator in. Oh, yeah! Look! That's right after the point where we turned bearish. Isn't this fun? It's much more fun when you know what you're doing. I'll grant you that. So we had a 4-hour direction change, the candle before, and then on the hourly chart, We tap this from underneath as resistance. And well, very simply, when your original D target breaks and retests from the other side, you simply trade to the next Fibonacci level down. That's called a bonus round. And I've got other ones underneath there. There's 200, there's 261. Okay, if this thing keeps going, so will I. For Monday, one of two things can happen. We will either find a floor at 2672, or we will find a ceiling at 2672. Right? If Monday we find a ceiling at 2672, my next trade will be the next bonus round. In this case, 25.58. Because we're going to hit that first. If we find a floor instead, or support at 2672, we go back up the same way we came down. So first we have to finish this bonus round, back up to this time from underneath 2743. It was 2744 on the way down. It's going to be 2743 on the way up. Well, these levels, Sanjay, that I'm pointing out. If on the day after we break 2743 and find support at 2744, this is now our D, our original target on the way down. Once your D becomes your floor, or gets broken and retested, your next target is usually 0. And by that point, guess what? You've got another retracement. You can draw a different fib. Okay, so for Monday, I'm looking to see whether 2672 is my floor or my ceiling. DZ, I'm afraid I'm out of time. But you can try this on gold on your own. In fact, I want you guys this weekend to pull up some historical charts, your favorite pairs, your favorite time frames. Do exactly this. Look for the zigzag. Find what stands out. Look left, there's your A and B. Look right, there's your C. Measure it. Prove to yourself that this works. And I showed you the hourly chart. I drew this on the daily chart. I didn't move it. You see, it's just as relevant. Here's the 5-minute chart. What if you're a short-term trader? Great. Wouldn't you love to know that there's a resistance level here that's holding before it starts to accelerate away from it? Truly time frame independent, you guys. Go through your favorite pairs. Go through the different time frames on each one. Look for the zigzags. Practice drawing a fib, see what happens. I think you'll be pleasantly surprised. All right, here's some links for you guys. Lastly, if you want to go further, first one is a daily newspaper that I put out every morning at 8 GMT. It's a summary of which financial headlines are getting the most clicks. Totally free. You can either visit that link every morning, daily, night, or you can sign up to get it delivered to you via Twitter or via email, whatever your preference is. Here's my own Twitter and Facebook if you'd like to follow me. Now, I mentioned fibs are not a complete system. They're a tool for a specific purpose. If you want to learn my system, how I trade personally, I've recorded a series of workshops. You can watch them on your own time at your convenience that cover every single indicator I use, how I use them, how I combine them. It also covers things like how to set stops, how to size your positions, trading psychology, probability, a bunch of other cool stuff that most trading systems leave out. Pretty much everything you need to know to be trading successfully. If you found today useful, we also have a live room. It's open 24/7. I teach in there twice a day. I set up my trades in the morning. Differently from trading signals, I don't hold your hand. I let you do some trading during the day on your own, based on the parameters I've set up. And then we get together again at the end of the day, and I coach you. What did you do well? What needs improvement? How can we do it better tomorrow? We do that twice every trading day, 10 times a week, 40 times a month, and it costs less than 1 or 2 losing trades for most people. Okay, so quit wasting your money on losing trades. Learn how to win. And the last link, very simply, if you're tight on money or tight on time, it's what we call our budget program, the weekly updates. You don't get to interact, you don't get to ask questions. We just send you a recording of the Monday morning videos. Why Monday morning? Because I just got a new weekly candle and a new daily candle, and I give you my most likely trade setups for the week ahead. So at least you're doing your trading with a little bit of guidance and not just taking random pot shots. But whichever way you prefer to learn, we've got you covered. Whether it's video recordings, whether it's live workshops. Either way, please visit fxknight.com, you guys. I've got a lot of useful free resources on there as well. Okay, it's not about selling you something. I just want you to know what options are available to you. Most everything on fxknight.com is totally free. Only thing I charge for is my time. You'll find a free chat room, free forums, free interactive charts, free indicators for MetaTrader, all sorts of goodies. So stop by and say hello. And please join me next Wednesday, this coming Wednesday, for Institutional Trading Strategies, the other webinar that I do. That's where I talk about some of the indicators that you can combine together with Fibs to fine-tune their signals even further. Thank you all very much, and I will see you next week.